are as bearish on U.S. stocks as possible. Joining us now, Cambria Investment Management founder and CIO Meb Faber. Meb, good morning to you. What does that mean, as bearish as possible? Are you looking international? Are you looking resources?
That sounds so sad and depressing. You guys are going to stop having me on with such an intro like that. But look, our largest fund is a stock. Our largest fund is a stock fund, a long-only stock fund. So I'm not just talking my book here, but to all the strategies we have, there's two pillars. There's the value side, and then there's the trend and momentum side. The bad news is across the board, they're saying red flashing light to U.S. stocks, okay? And on top of that, red flashing light to tech stocks too. So the funds that we have that can be 100% hedged are. The funds that we have that can be momentum and trend are not investing in U.S. stocks, with the exception of energy and materials, right? It's a lot of commodities. The value strategies are avoiding tech stocks. I think there's only like 5 that we own or something. And it looks like names from like 1999. It's like HP and Xerox, none of the kind of high flyers. So, but this makes sense, you know, to me, in this environment we're in. We're in an environment where stocks are expensive still, even though they're down some. Long-term P/E ratio is around 30. That's for a normal inflationary environment where you have an average long-term P/E ratio of around 20. In the inflationary environment we have now, where inflation is up at 8%, the normal multiple you have is 10. So we're at 30, and normal average is 10. Now, you can make the reasons why that shouldn't be so, but historically that's been the case. And so this setup is saying, look, if this is going to stick around, there's potential a lot further to go. And the thing we've been saying for the last couple of years is say, look, wait till the trend turns negative. These high flyers last year, the year before, they can always go higher. But when the trend turns negative, it's time to get cautious. And that's been the case this year.
Yeah, I mean, a lot of our guests have said that caution means holding on to cash in this inflationary environment. Is that sort of where you're heading as well? And I wonder your thesis. Does this assume a recession?
No. So I'm probably the only person. There's 2 people that have this line of thought that I've ever met, and we have very different conclusions. We did a post called the Stay Rich Portfolio on my blog that examines cash as a safe investment. Everyone assumes cash is the safest investment. But if you look at cash on an after inflation basis, so going back for the past 100 years, cash is lost, and cash meaning T-bills. So not just putting things under the mattress, but actually putting in T-bills. After inflation, at one point, you lose half. Okay. And so we did a post that said you have to invest, and it could be a global portfolio. It could be stocks, bonds. And we're saying that's struggling this year. And the third missing piece that almost no one has, unless you're Australian, unless you're Canadian, is real assets like commodities. Okay. That portfolio historically has been safer, less volatile, and a lower drawdown than cash has been over time. And you can mix it with cash. So you say, I'm going to invest half in cash, half in this global market portfolio, has been a much safer alternative. Now, no one does that. I do it with my own personal money. My company does it with our balance sheet. The only other person that invests their balance sheet that I've ever met is Michael Saylor. Now, he comes to a different conclusion. He says cash is trash. I'm going to put it in crypto.
Right.
But this line of thinking, by the way, is changing in a world of 8% inflation.
I mean, I don't know about, right, as you said, cash as an investment. But, you know, as some place to park, instead of doing something dumb, cash tends to work pretty well, right? Because it's not going to go down 50% in a few months, at least not historically. We hope not. It tends not to do that, like so many growth stocks and cryptos have. And so I wonder, when is it time to start getting, I mean, to use market parlance, greedy again? You look at some of these growth names that have some pretty strong underlying fundamentals. You know, in technology land, they have some pretty strong technology overall, and they're way, way down, sometimes more than 66%, 70, 75% down. I mean, certainly at some point when the business is sound, the moats are real, there's an advantage there.
For a long time, and this goes back to my very first book, Ivy Portfolio, we did studies that show what is it when you buy an asset class, a sector, an industry, when it's down 60, 70, 80, 90%. And historically, you close your eyes, hold your nose. It sounds insane, but you buy it for 3 to 5 years. That usually works out. And so over the past 5, 6 years, that's been a lot of the ag and energy complex. It was coal stocks. It was uranium stocks that had just been absolutely decimated. And here we are in 2022 talking about energy having amazing returns when 2 years ago it was negative. So there is a point when that will probably happen. On the tech side, we're finding a lot more opportunity, going to your last guest, in emerging markets, right? Emerging markets, we have a huge overweight in tech and emerging versus the US, which is only like a 5% weight. So value opportunity there, but a lot of those markets have been really beaten down too.